Good morning, everyone. Good to see you all here. Thanks again for a very good first day yesterday. And I think a wonderful evening with the public lecture last night. And I hope some of you were able to get a bit of a sense of Stellenbosch at night afterwards as well. So good to see you all back. I just wanted to make one announcement, a program change. So on the session, the first session tomorrow morning, that's session 8 on agriculture, the chair of that session will change. So Elina Amadila, who's at the back there, Elina is from the University of Namibia. She's one of the local organizing committee members of this symposium as well, and she will be the chair of that session. Any such changes on the program will make on the program, and the final electronic version would serve as the final version of the program. You can always access that on the STIA's website for future reference. So with that, let's get started with the day. Stan.
Thank you very much. Good morning. My name is Stan du Plessis. I'm based here at Stellenbosch University, and it's my great pleasure to chair the session on finance this morning. I hope you enjoyed yesterday's first session as much as I did, and especially the public lecture last night. It really was a highlight for us, and it is why we organize these Nobel Symposia. This morning, we have a wonderful session. We've got 3 brilliant speakers lined up. We're going to start with Emily Breza. So Professor Breza is the Frederick E. Abe Professor of Economics at Harvard University, and she works on development economics with a focus on financial markets, labor markets, and social networks. And then we've got 2 respondents, Professor Lorenzo Casaburi from the University of Zurich, and he specializes on market structure, behavioral insights, and agricultural finance. And then finally, Professor Dean Karlan, who's the Frederick Esser Nemers Chair of Economics and Finance at Northwestern University. Now, for me, one of the takeaways yesterday was the balance between the great strides we have made in development economics and the realization that much remains to be done. So I recall a lecture by the renowned philosopher of science, Karl Popper, which he gave at a period in his career when he was already far too famous. So he just spoke in numbered paragraphs. And he started the lecture by saying, the first thesis is that we know a great many things, and that amongst the great many things are useful theoretical and practical insights. And then he said, then the second thesis is our ignorance is boundless and sobering. And the third thesis is that we find the problems of our science in the tensions between thesis number 1 and thesis number 2. And we saw a lot of that yesterday. We saw wonderful lectures about how much we have learned over the course of the last 20 or more years. And we also saw an agenda mapped out because our ignorance is boundless and sobering. So let us also take that into our day this morning, and I'm going to invite Emily to the stage. Emily, we are looking forward tremendously to your lecture.
Thank you. Thank you so much for having me. As many said yesterday, it's been very inspiring to be part of this. So I want to start with some correlations that we've seen for decades. The oldest I could find plotting these empirical relationships was from 1963. We have something on the left where on the x-axis we have some measure of GDP, and on the y-axis we have some measure of the size of the financial sector. And on the right we have the same relationship from 2019, where I'm looking on the y-axis at the fraction of adults with some sort of financial account. And perhaps unsurprisingly, these relationships are extremely robust. Now, why might some of this be causal? Well, there's a long history in banking trying to understand, well, what do banks actually do? So first, they mobilize and pool savings. And this is going to overcome the cost of collecting from many small households. And what's important in the background is providing the trust through the regulatory environment that households feel comfortable doing this. So this is going to matter for the savings side, and the transaction costs are going to matter. Second, on the credit side, the financial sector is going to allocate capital, and what this really means is trying to deal with information frictions. So it's going to produce information ex ante about possible investments, so screening, and also produce information ex post, monitoring. it's going to facilitate the trading, diversification, and management of risk, which is important, especially in the context of what Chris was telling us yesterday with insurance. And one implication is that this is also going to allow households to move consumption forward in time through savings and credit. So clearly this is a big ask. The financial system is doing many things, and with wide-ranging and potentially heterogeneous consequences. And the place I'm going to start in thinking about what we've learned is the fundamental problem that many of these functions are going to be costlier in developing country contexts than in high-income countries. So what has historically prevented the financial market from expanding? That's where I'm going to start. We're then going to think about what we've learned from financial market credit expansions, and then I'm going to end with where we are now in this new digital landscape. So I'm not going to do justice to the savings literature, but we have a tremendous amount of evidence on what happens when you reduce the cost to households of interacting with the financial system. And Pascaline did some of the early work breaking new ground in this space. So we have studies thinking about this from many directions. So first, reducing account opening fees. Second, increasing the interest rate on savings. Third, creating momentum, getting people to use accounts by putting money directly into them, so paying government transfers or wages into those accounts, giving people debit cards to lower those transaction costs. Also maybe lowering the cognitive cost by sending reminders. So all of these things have had effects on getting people to use accounts more, use those accounts in the first place and then also use them more. And we've seen different types of profiles of impacts from this access to savings. So consumption smoothing, and for certain types of savers, investment impacts as well. And the financial sector globally has responded by trying to reduce these costs. So this is data from the Global Findex between 2011 and 2021, and global account ownership increased from 51% to 76% over this time. So there's been tremendous strides in getting bank accounts into the hands of adults around the world. And a lot of this growth, unsurprisingly, because that's where a lot of the people are in developing countries. Part of this is driven by government policies attempting to reduce these costs. So for example, a lot of what was going on between 2014 and 2017 was a large program in India that in 2 years increased the number of bank accounts from 125 million to 260 million. And many governments around the world, and this accelerated during COVID, have done more to put social transfers directly into these bank accounts. Now, moving to the credit side, we know that information frictions are really a core challenge. And so some of the research, I think, has done a nice job in telling us how bad those information frictions can be. And there's been progress in thinking about diagnosing the type of information friction. Now, one big question that has been hard to answer is, when we see somebody default, why are they doing it? Are they defaulting because their business really had trouble or their household doesn't have the resources? Or are they defaulting because they have the resources, but they would just prefer not to repay? So Bluin and Machiavello, in a recent paper, have a very clever test for trying to think about how much this strategic default is a problem. And they're going to look at the international coffee market and isolate one particular type of contract that can help us learn about this. And these are fixed price contracts. So people will take a loan and then repay in coffee cherries. And one type of contract sets the price at which you'll receive for your coffee cherries in advance. Now, if the realized price is higher than anticipated, you have an incentive to side sell. And the finding of this paper is that 50% of all of the default seen in this supply chain lender is actually strategic default. So this is a really big issue that we need to solve to think about expanding credit supply. And this echoes with themes from a classic paper by Dean and Jonathan Zinman, Observing Unobservables. That is an ultimate classic advance in empirical and experimental design to try to tease apart adverse selection, repayment burden, and moral hazard. And he finds that there's substantial moral hazard, especially when it comes to dynamic incentives. Okay. So given that strategic default is such a big problem, then what can we do about it? What can banks and the financial sector do about it? Well, collateral is the thing that most people first think of, and that what banks rely on. But in developing countries, these types of creditor protections and the ability to actually go get your collateral in the case of default aren't so great. So work in Manaswini Rao's job market paper shows that in the case of India, the court system is just not working very well for financial intermediaries. On the left, financial intermediaries are very likely to have cases before the courts. But on the right, these cases take ages to work through the court system. So when there's a judge vacancy, it's particularly bad, and the average case takes about 525 days to get through the court system. So this is just really not going to be feasible for households and small businesses to receive bank credit. And Jacopo Ponticelli shows in the context of bankruptcy reforms in Brazil that fixing the system actually does increase credit supply. So this leads us to think about the effects of banks. So we know that banks are mainly dealing with collateralized lending. The research that we have on bank branch expansions is quite rosy. So Burgess and Pandy in a classic paper on the impacts of banks on the economy show that the government asking banks to expand, giving them incentives to do so, actually reduces poverty headcounts. And this replicates in some recent RD evidence. But there are going to be limits to the types of people who can benefit from these bank expansions for the reasons we just talked about. And even worse, evidence by Mishra and Rajan shows that banks are pretty slow to innovate. Even things like adopting data from credit bureaus takes a long time for banks to be comfortable doing in their system. So what does that mean? Well, that means that a lot of households and small enterprises are going to be left out of the formal credit system altogether. And from the Global Findex, again, we see these types of patterns. So in high-income economies, the vast majority of borrowing is through the formal sector. But in developing countries, it's the minority of borrowing. And what are people doing instead? Well, they're borrowing from moneylenders, and they're borrowing from their friends and family. On the top right, this is data from summary statistics from Esther and Abhijit's Miracle of Microfinance paper. And you can see in their control group, only about 4% of households have any sort of loan from a bank, but 63% have some sort of informal loan. And looking at some data from Vaishnavi Surendra's job market paper, we can think about what this means for the cost of credit and the kinds of credit that's available to everybody else. So on the bottom left, I know you can't read the labels. This is showing loan size by type of lender. The first column are banks and other types of formal institutions. Those give high ticket size loans. The middle are money lenders, and the right are friends and family. And then the right panel is thinking about the interest rate, the cost of those loans. So the bank loans are the first ones, about 10% interest. Money lenders are in the middle, so much higher rates of interest, 40%. And then friends and family, often these are types of reciprocal risk-sharing transactions, and they're not priced. So this shows the segmentation. Banks are serving the wealthier clients with larger loans and lower interest. And then money lenders with high fees and lower loan sizes are, and this other types of informal borrowing are what happens next. Okay. So then we can think about advances to what happens when the formal credit supply is able to expand. And the first place to look for evidence on this is microcredit. Microcredit is one of the only scalable ways that we've seen where formal credit can come in these contexts with very low levels of banking, offer collateral-free loans, and actually do this in a sustainable, profitable way. And the fact that the default rates have been very low traditionally in microfinance suggests they've found a way to solve this moral hazard problem with their contract structure. In 2018, the global microfinance market had 140 million borrowers and was about $124 billion big. Okay. As Esther and Abhijit have talked about yesterday, the original evaluations of microcredit were a bit disappointing. The lenders had this great story for how the poor are natural-born entrepreneurs, and all they need is credit, and there'll be these transformative impacts. And as we've talked about yesterday, these impacts don't really seem to be there for the average borrower. However, maybe we shouldn't expect them to be there for the average borrower. In the India study, only about 50% of borrowers have any business at all at Endline. And so if this is a story about transformative growth and the median borrower doesn't even have a business, then there's something wrong with that. So many are borrowing for consumption and not for business growth. And for them, that might be the optimal thing to do. Buying the TV or the refrigerator is still potentially beneficial, but it's not consistent with that story of transformative business growth. And so as also mentioned yesterday, we've gone back and looked at the original India study, but 6 years later, and we've thought about thinking about this heterogeneity a little bit more carefully. And specifically, we look at the types of entrepreneurs who had a business before microcredit enters, and we're going to call these the gung-ho entrepreneurs. And it turns out that for them, the 6-year profit impacts are quite large, and that's the group on the right. And they're driving actually impacts that you can see on average now after 6 years. And there's not much going on for the non-gung-ho entrepreneurs, largely because a lot of them don't have businesses at all. And so we show and we argue that these gung-ho entrepreneurs are going to exhibit dynamics consistent with a poverty trap. When microcredit is available to them, they borrow from the microcredit, they borrow a lot more from their informal sources, and then they expand in a persistent way. We also show that microfinance actually causes the weaker businesses to enter. And so that also helps explain why these average returns don't seem so high. Okay, so given that microcredit is getting credit out there, the impacts are heterogeneous, where do we go from there? And I think there's been a really exciting set of literature refining the microcredit model and giving us some hints for where we should go and where maybe policymakers should push lenders to go. The first refinement is just directing more credit to higher return businesses. And Dean has a nice paper in Egypt where they actually just give much larger loans to businesses. And they show that in the top quartile, profits go up quite remarkably. However, this isn't true across the board. Bari et al. In Pakistan have a different idea. They're going to take seasoned borrowers from a nonprofit lender and offer them a new kind of product. So in the status quo in their control group, people can qualify for a $500 microloan after finishing their previous loans, and about 30% of people want this. However, they're going to experiment, the authors, with a new kind of contract structure, which is a higher pay contract. This allows people to buy a specific asset valued up to $2,000, so 4 times larger. The borrower pays 10% down, the bank pays the rest, and then over the course of the financial term, there are rent-to-own payments, and at the end, the borrower owns the asset. The pictures just show the distribution of impacts, and so you can see that these businesses in the treatment group are much larger, and their profits are higher. And also, some of these other things that the microcredit institutions were predicting are starting to happen. Consumption's higher, education expenditures are higher, et cetera. The second refinement is thinking about prospects for segmenting the market. Okay, so if we get the loans into the hands of the businesses that have productive uses for them, well, how do we do that first process? The first question is, can you get them to self-select? And Lori Beeman and Dean and Chris have some work in Mali thinking about a loan that's well-tailored to the agricultural lending cycle. And actually, indeed, the people who self-select into the loans have higher returns. So this poses a bigger question. What happens if we can give people better choices? If we can give them savings products or insurance products and don't force it all on high interest rate credit? Can people actually just select into a different choice? Second, this is something that was discussed last night, peer selection. So Reshma Hassam, Ben Roth, and Natalia Rigol have a very nice project in India where they study 1,300 micro-entrepreneurs and give them a lottery to get a $100 grant. Now, they group them into people who are on the same block or the same street, and so they would sort of know each other's businesses. And they ask them the following question: of these other people on your street, who could grow their profits most if they received the grant? And the results are quite striking. For the people in the top third of the distribution, the treatment effects of getting that grant are quite high. So that means they have very high returns, and the peers were able to predict it. For the people in the bottom of that distribution, those returns are 0. And so if you can lend based on this, you could reduce this misallocation and really get some of these productive productive benefits more successfully. And then finally, what about alternative data sources? And I'll come back to this at the end in the context of digital credit. But in Dean's Large Loans project, they're going to think about psychometric characteristics, and those turn out to be predictive of these treatment effects. And so what other kinds of data can we bring to bear on this problem of finding the entrepreneurs with high returns, and so being able to channel larger loans to that subset? The third refinement that there's been a lot of research on is designing for the needs of the business. And then I think the one with the most research is flexibility. So what I'm showing here are 5 studies that try to take the microfinance contract and add some flexibility to it. Now, the standard contract says you get your loan, and then within a week or a month, you have to start repaying right away. And that's not really going to be that useful for lots of businesses. If businesses are trying to take risk, it might take time to install those assets. It might take time for those assets to start generating return. So asking them to pay right away is putting them in a straitjacket. And the first paper that thinks about relaxing this is the bottom one, a paper by Erica Field, Rohini Pandey, and co-authors, where they simply just give people grace periods. They give them a little bit of breathing room before they have to make those first payments. And the results are quite striking. The firms that are in that treatment group have a 41% increase in profits. They also start doing those other things, just as in the Bari study, consumption goes up, the investment in schooling goes up, the women's empowerment indicators start to go up. But the problem is default also goes up. And the lender didn't like that, and the lender didn't want to continue that type of product. Now, since then, we've had 4 other studies that have tried different variants, making the grace period even more flexible. And many of those studies have also found similar impacts to profits, and some have even found ways to decrease default. So I think there are ways to tweak this contract to actually make it look more like what the businesses need without increasing default by a tremendous amount. And I think one thing that's a bit exciting about flexibility is that we're starting to now creep toward something that might look like equity financing or financing based on cash flows, which is what we see for financing entrepreneurship in high-income countries. And then also there's been some positive effects of products that are matching the timing or need of the firm. So a paper that came up yesterday is Kelsey's work on loans during the hungry season. Ted Miguel also has a very nice paper on loans to delay the sale of the maize harvest for farmers in Kenya. Okay. So the first wave of evidence showed that, on average, the impacts aren't quite what the lenders touted them to be. However, if we refine the contract, there can be, much bigger productive benefits from those loans. Another wave of research that I've been a part of has tried to think about what credit is doing in general equilibrium. And so, there are sort of 2 forces that could lead to general equilibrium effects. One is exactly the productive investments. Business start hiring other workers. That creates increases in labor demand. But also just having people consume locally could have impacts on the local economy. And so if a lot of those people are taking a loan to just consume earlier, that's also something that in developed countries we think about as potentially generating multiplier effects as well. So Cynthia Kinnan and I look at a natural experiment in India where credit was abruptly withdrawn from the system. And we show that the rural household in a district that was highly exposed loses $25 in credit. And wages fall by 4%, and these impacts are larger for the non-tradable versus the tradable sectors. And we also show that consumption falls by 5%. And this is consistent with the consumption multiplier greater than 2, which we also see in a very different context in some of Ted Miguel's work. And so this suggests that small loans to rural households, even though they're not very well targeted, can nevertheless move the local economy. And this says that regulators should pay attention and need to provide a stable regulatory environment for them. Okay. Another type of GE impact relates to the fact that, what were these households doing in absence of formal finance? Well, they were borrowing from each other. They were engaged in risk-sharing networks. And so another question that I've addressed with Esther and Abhijit and others is trying to think about how microfinance might actually impact those informal financial relationships. So we're going to use data from 2 experiments, a natural experiment and the microfinance experiment combined with detailed social networks data that Esther and Abhijit collected prior. And we're going to ask the question, are there impacts for people on their social network relationships? And are these impacts even visible for the non-takers, the people who themselves aren't likely to be borrowing? So we're going to classify everybody in the sample into either a high propensity borrower or a low propensity borrower. Now, if a high propensity borrower is saying, great, I can go borrow from the microcredit instead of my financial network, that might mean that these high propensity borrowers are going to withdraw from relationships. So we might expect the high-low links to fall, and we do see that. But we also see the low-low links to fall, and that's a bit of a puzzle. So then we can ask, well, are the low-low links falling because they're just in a relationship with a high propensity borrower? And so maybe Lorenzo, Dean, and I are all friends. We're only friends together. Dean gets access to credit. He withdraws. And then Lorenzo and I say it's not worth it anymore. Potentially, those triples of links fall. But we also see that triples of low, low, low links also fall. So groups of 3 people who had a relationship before, none of whom are really very suitable or interested in borrowing from microcredit, even their relationships are affected. And we also show that the Ls experience worse consumption smoothing when microcredit enters. That means that the relationship between their income and their consumption is stronger. Their risk smoothing is worse when microcredit is there. And so I think this has different implications for credit policy. First, if we're going to think about subsidizing lending, we should do that in places that don't have as much informal credit. And then second, when we're bringing in credit interventions, we should think about this more holistically again. What other types of things could the L people use if they're not interested in credit, for example, savings and insurance? And so thinking about this much more broadly than just one product at a time. OK. So in my last 6 minutes, I want to talk about some exciting trends that are going to change a lot of what I just talked about. So in the spirit of not knowing anything, I think that's kind of maybe where we're heading toward again. OK. So digital payments are a really exciting new phenomenon that have accelerated during COVID. And the place where digital payments were already, thriving was on the continent. So I mentioned before, the Findex, in the global Findex, we see account ownership at all over 10 years rising from 51% to 76%. And 8 percentage points of this gap is coming from mobile money accounts, largely in sub-Saharan Africa. And over this time, mobile money started in East Africa and has intensified and spread to many other markets. And Kenya's M-Pesa is a global leader in mobile payments. And the initial capabilities were basically to leapfrog the expensive banking system and go directly into the kind of mobile-based accounts. So people would get a mobile wallet linked to a SIM card. They could cash in and out at a network of agents. And in the first iteration of this, the big thing that they could do is low-cost person-to-person transactions. And this lowers the cost of sending money to the network and engaging in those informal risk-sharing relationships. And Tavneet Suri has an important result in this space, documenting that this has big impacts on risk-sharing networks. So she did surveys during the really fast, impressive rollout of M-Pesa, and she can show that people who have M-Pesa are less likely to need to cut their consumption after an adverse shock. And this is likely coming through the network because you see an expansion both in the likelihood of receiving money from somebody else and the number of partners that you can receive money from. So this has been a game changer in thinking about which types of risks can be diversified and crowding in those network relationships from a broader spatial set of areas. In addition to mobile money, we've seen a much broader expansion in digital payments. And this is driven by some other interesting new phenomena. So the top, again, is from the Findex. And the right panel is focusing on developing economies. And the total height of these bars is the total fraction of adults with an account. The teal-green section is the subset of those individuals with account making or receiving any digital payment. And so we can see over those 10 years, digital payments have become extremely widespread. This is data from 2021, and I suspect if we look now, it would be even more stark. COVID was a big driver of digitization, and this has really moved very, very quickly in the past 5 years. And we've seen different models, aside from the mobile money model, emerge. So Brazil and India, in the past 5 years, have both gone in a very similar direction, with government-led, free instantaneous account-to-account digital transfers. So in Brazil, it's called Pix. In India, it's called UPI. And on the right, you can see some of the power of this. This is a food vendor in a market, and he has a QR code sitting on top of his egg crate. You buy food from him, and you pay on your phone on this QR code. I talked to some JPAL Brazil staff last week. They said it's the exact same thing. You go to the beach, you buy your coconut water with a QR code on your phone. And so this is now digitized transactions that we never thought before would be digitized. Now, what does this mean? I think this has really interesting, exciting implications for those frictions that I laid out at the beginning. Those transaction costs have now gone way down. You can do direct debits from your mobile wallet for payments. You have data for screening and monitoring. There's a lot of research showing that these digital footprints are very predictive for different kinds of lending. There are new mechanisms for data sharing based on these new data trails. So India has a system called the account aggregators where you can actually send your transaction history from one bank to, let's say, a fintech if you're trying to take a loan. And we see increased pledgeability of assets. One small piece of this transformation that has been studied is the rise of instant high interest rate credit, and this is largely in the mobile money context in Africa, and also from fintechs. And so we have work from Kenya, Malawi, and Nigeria by Tavneet, Pascaline, and others, showing that expanding this consumer credit access through these easy-to-get loans shows improvements in resilience and in subjective well-being. However, we need to be a little cautious because there are high interest rates, high rates of default, and also lower consumer knowledge. So this is consistent with borrowers having particularly bad outside options. Their cost of that informal finance is so much higher, but it's something to keep an eye on. And I think regulators and policymakers are anxious about the rise of this type of digital credit. Another advance in pledgeability comes from digital collateral. So in one of my classes, I had a student who had interned for this company, Sun Culture, and she was talking about this, this new model that they had a few years ago. So they sold pumps and televisions attached to solar panels that would power them. So one is productive, one is for consumption. And these assets are expensive, and so they came up with a new lending model. People can pay for the asset over time using M-Pesa. And then if you don't repay, you can disconnect the solar panel remotely and lock people out. And so this is digital collateral. It's remote. You don't need to go through the court system. Once repaid, and then when you start making payments again, they can switch your asset back on. And then moreover, once you repay this loan, your asset now can provide collateral for other types of credit in the future. And Gertler et al. Actually do an RCT with a similar company, switching on and off digital collateral, and they show that turning on the digital collateral decreases default by 19 percentage points. So this can potentially expand the credit supply with these new types of sources. But I think we do need to be a bit cautious. There are high levels of lockout. The median borrower is shut off a third of days. And if these are productive assets, we might worry about those consequences. And so we need to think about how to design these products to expand lending but reduce harms. And one place where we have seen harms are in starter interrupter switches on cars for car loans in the US. And so the consumer protection issues are big. So I just want to conclude by saying that, given that digital credit has just arrived on scene and has all these potential, all this potential to solve these issues that have been pretty intractable for a long time, the research is wide open. So what about credit impacts on lending to entrepreneurs? What is that? Where is this model going? Is there scope for distributing insurance and increasing savings? How should we think about reducing gender gaps if men are more likely to have smartphones than women? In addition to consumer protection, where does the government still need to intervene to potentially ensure some of these productivity benefits? And then given that we now have a few different models, which of the models, what are the pros and cons of like an M-Pesa type model or a UPI type model in India? So I think we're at a very exciting moment where there's a whole new set of questions that we can now start to think about. Thank you.
Emily, thank you for that wonderful sweep of the literature and also the indication of where the literature is heading. And now we have the opportunity to hear our two respondents. I'm going to invite Professor Casaburi first. Lorenzo, please.
Thank you very much. Okay. So good morning, everybody. It's a great honor to present at this event, and thanks, Emily, for a great talk. So in this brief response, I want to expand on a concept that came up at several points in Emily's talk, which is this idea that financial services are often provided within other type of interactions, often within value chain relationships, for instance, in the digital collateral case that she was making. Classic examples are buyers providing input credit to suppliers, or sellers providing trade credit to buyers, or employers providing a range of financial services to their employees. And so I want to think of value chain microfinance as the provision of value chain financial services to the type of low-income individuals that microfinance targets, including consumers, workers, and small entrepreneurs. And of course, in development, there is a prominent old literature on this idea that financial transactions happen together with transactions in output markets or in land markets, these interlinked transactions. And there is a small but growing literature that has focused on this topic and overall a renewed interest that I think is based on three key elements. So the first one is rigorous evaluation of value chain microfinance products. The second is new product design, often with economists collaborating with firms. And the third is the discovery of new benefits of linkages that have often been related to insights from behavioral economics, and these benefits have added to traditional motivations for linkages, like informational benefits, enforcement benefits, or lower transaction costs. So in this brief response, I want to do two things. I want to give some insights of existing research in this space, in particular highlighting how recent research has gone beyond credit, which has been the traditional focus of value chain finance literature, to look at savings, insurance, and more recently, microequity. And then I want to highlight some open questions and future directions for research. Okay, so that's a plan. And so let me start with savings. Across a range of settings, there is evidence that the frequency at which sellers receive payments from buyers or at which employees receive payments from employers may affect their ability to save. And indeed, the studies in very different settings have documented a strong demand for infrequent payments. Okay? I prefer to be paid once a month, even if I sell a good every day. And at least part of this demand arises from self-control reasons, from aware sophistication about self-control. And so the idea is that the bundling between the saving market and the output market or the labor market may provide a stronger form of saving commitment than other arrangements, other forms of illiquid payments. Okay? Now, one implication is that if people like to be paid, let's say, once a month, as opposed to every day, there will be only a subset of high reputation, credible buyers that can satisfy this demand. I better trust that the buyer is not going to run away with my money at the end of the month. And this is potentially a source of market power in the interlinked market. Okay? So more generally, recent contributions listed in this slide have been trying to understand how this interlinking affects competition and market structure in the interlinked market. The second domain is credit. Again, value chain credit is arguably the most studied product within value chain finance. One classical example has been input loans that are repaid through deductions from future sales. And there's been a lot of experimentation, around this product. One very nice insight that has come up in recent work by Bill Jack, Tamnit, Yost, and Kramer from Kenya is the analysis of the same asset collateralized loans, in which the same asset that the loan intends to fund is used as a collateral. Okay? And this is in the context of rainwater harvesting tanks. This work shows higher take-up when this type of collateral is used compared to other alternatives, higher productive benefits, while retaining low default rates in a setting, again, in which repayments occur through deductions. Follow-up work shows, again, a behavioral channel. Okay? The idea is that if I have to use an asset that I already own to fund something else, the endowment effect will kick in and may depress demand because of loss aversion. If I use an asset that I don't yet own, initially there is no endowment effect, but then as soon as I get the item, loss aversion kicks in. And if I'm naive about this, if I don't expect that this will happen, this may actually have ambiguous welfare consequences on whether self-collateralization is a good idea or not. So the third domain I want to talk about is insurance. This is a paper that was mentioned in a couple of sessions yesterday. So briefly, the basic idea here is that we typically think of the gains from insurance coming from transfer across states of the world, but many insurance products imply an intertemporal transfer. Think of the crop insurance example. And so we show, and this work has been also documented in other settings, that there is higher take-up when the payment of the premium happens at harvest. But this is very hard from enforcement purposes, right? And so, for instance, this can be implemented in a setting where the buyer can deduct the premium payment at harvest time, but it's not necessarily easily scaled up in many other settings where such enforcement is not feasible. Importantly, even in this case, one of the benefits of the value chain finance aspect is that they remove barriers to demand that are related to behavioral aspects. Trust. Trust is super important for a product where you don't get any money when you buy, right? In insurance, you don't get anything when you buy. And also in removing present bias coming from the intertemporal transfer. Okay, fourth, I want to talk a bit about microequity. I think it's something that is going to have much more research in future years. We've been talking about flexibility in microfinance products, but there is probably more to be done in this space. Why haven't we seen more of this type of products, where one traditional channel for performance-based finance is observability or unobservability of the outcome, unobservability of the returns? And even in this case, value chains may help. Value chain partners often observe performance or a sufficiently good proxy. For instance, in a recent nice working paper, Cordaro, Muhammad Meki, Simon Quinn, and others, they work with a multinational Kenyan food producer that wants to finance assets, bicycles, for its micro-distributors. And they observe stock purchases, so they have a good sense of the revenues that can be generated. And this is a platform in which the researchers working with an MFI can test different financial terms, and they show that an hybrid product that has both a debt component and an equity component has better outcomes than both a traditional debt product and a full equity product. Okay, and I think there's much more work to be done in this space. Again, I want to emphasize that feasibility on this product here relies on the multinational having good data on revenues of the borrowers. Okay, so in the second part, I want to talk about some open questions and hopefully interesting area for future research. So the first one is this relationship between value chain finance and the financial sector. Okay, and broadly speaking, I see two views with regards to this. One view is that these things are substitutes. Okay, as better information becomes available, as enforcement improves, maybe the competitive advantage or some of the rationale for value chain finance will disappear, and this type of arrangements will become less important. Another approach, which is very much emphasized in the practitioner literature, is external value chain finance. Is this idea that the financial sector can leverage value chain relationships to penetrate markets that otherwise will be hard to reach. And so, for instance, the paper I was discussing earlier, the microequity, is one example of this sort of interaction between an MFI, the manufacturer, and the distributors. Much more work to be done on this space in understanding the potential of external value chain finance. For instance, just one example, receivable financing for aggregators is something that the literature talks a lot, but we don't have rigorous evaluations of the benefits. Another approach that we are conducting in ongoing work in East Africa with this initiative called Aseli Africa is to understand whether incentive to banks to expand in one sector, for instance, to expand loans to small and medium enterprises in the agricultural sector, whether these incentives trickle down to an increase in value chain arrangements between the firms and the farmers upstream. Okay, and so testing whether there's this complementarity between financial sector expansion and value chain finance expansion. Second, I want to come back to something that Emily mentioned in her talk, which is strategic default. And while one of the benefits of value chain finance is better enforcement, enforcement is by far not perfect, even in this type of relationships. The classical case is side selling in contract farming. Mackie and Quinn, who have been working on microequity, also talk a lot about sale diversion in this context. And so much more work is needed on this topic. Of course, Emily mentioned a beautiful paper by Bruna and Machiavello on contracting adjustment in response to strategic default. Let me make one point that I think is important. In these settings, we think a lot about moral hazard of the borrowers, right? That's a standard. But in these relationships are often double-sided moral hazard. A company provides loans to the farmer can sell away, but then also the company is late in providing inputs, it provides lower quality inputs, lower prices. And so understanding the dynamic between this double-sided temptation is important. For instance, if we make the buyer better on this margin, are we going to observe a lower side selling in response? What happens if we increase the value of the relationship? In general, much more work is also needed on which punishment strategies are feasible and advisable in response to contract breaches in this type of environments. Last, I want to talk about land markets. Okay? So I think that among economists working, including on Sub-Saharan Africa, there is a growing awareness that land markets are becoming more important, are more active than we thought maybe 10 or 15 years ago, especially in certain regions of the continent. Nevertheless, the land misallocation persists. And this is something that has been documented by quantitative approaches, work by Diego Restuccia and co-authors, and recently in experimental work that I've conducted with Michelle Acampor and Jack Willis. And indeed, one barrier to land reallocation could be financial constraints. For instance, there is some work that shows that in response to large grants, certain households at least substantially expand their land ownings in Uganda. And so one question is whether there is a role for value chain finance for land markets, which I don't think it's something that has been explored so far in the literature. And the idea is that it's a bit getting right who the high return people are. And the idea is that value chain partners may have better information on who the farmer that will benefit from expansion are if they have records of production. Okay, so again, this would be one case in which the informational advantage may be relevant. More generally, land is the main asset for the poor. Land is obviously a very heated question. This country is a perfect example. So maybe it's time to revisit a bit the literature more broadly on land and finance. Of course, there is the traditional literature on the collateral channel of better property rights, work by Besley and Gatak and many others. Let me propose a couple of other avenues. So one is more sort of macro development. There are recent work, for instance, Manish Sheva's job market paper a couple of years ago that tries to bring together the macro level literature on financial frictions and on land misallocation. The other is new data. Okay, so things like credit registries, credit bureau information, land registry are gradually becoming more available, even in relatively poor countries in the continent. For instance, there is some nice work by Andrea Limodio and others that use credit registry to understand the effects of land reforms in Rwanda. And I also want to take this last point to talk a bit about a point that came up yesterday in a question. My hope and expectation is that this type of data are going to become better and better, even in this region. Okay? And so this may reduce barriers to access for equity research, the same way that it has happened in a random country in Sweden, or in Latin America, in which more and more research is done with this AMIN data, including by local researchers. So I think this is a very important development that I look forward to seeing in the next few years. Okay, so let me conclude. I think that recent research has provided very nice insights on value chain microfinance. New domains like saving, insurance, and equity, evaluation of new product designs, and new types of benefits often tied to behavioral economics. And there are several exciting directions for future research, including a better understanding of the interaction between value chain microfinance and the financial sector, and the role of value chain finance for the growing land markets in the region. Thank you very much.
Thank you, Lorenzo. Thank you very much for those comments, Lorenzo, and I invite Dean Karlan to give the final response. Thank you, Dean.
Great. Hi, everybody. Thank you as well for the opening talks and the thoroughness. I'm not going to be nearly as thorough, but thank you very much for the honor of inviting me here. So I'm going to open up with a true story. When I was on admissions for the PhD program, there was a opening statement in a personal statement that said, while traveling abroad, I learned that people have different preferences and allocate their resources accordingly. And so let's put aside the traveling abroad part. The second part actually does have an important challenge for measuring and understanding the impact of access to credit, which is that money flows everywhere, gets used in many different ways. If we want to understand what is the impact of microcredit, like some of the papers that Emily was referring to, what are we going to measure? I think of sometimes finance as like measuring finance and measuring impact of financial services like pouring water on a table, and the water just kind of flows in every which way. And if you're trying to catch it, you're kind of running around trying to catch it, but you don't know when it's going to go and where it's going to go. And so you risk actually finding some null results that aren't really null. It's just that you don't know where to measure and you don't know where to go because of its kind of pervasiveness. And so, oops. So I'm going to try to talk about two different things, but I ended up finding them to be blended together. Like what we were asked to talk about, what have we learned in the past 20 years and what are our voids? But I've always found something very odd about being a professor. Or maybe you could say many things, but one in particular, which is people say, ask me, expect me to know stuff. And yet, by choosing this profession, in a sense, I think I chose this profession because I recognized how little I knew. And that's why I choose to be a researcher. My original goal was learning more about what works and what doesn't in alleviating poverty and setting policy. And if the information was out there and I felt like I knew stuff, then I would probably just go do stuff. And I'm still in this job, right? So that still means that fundamentally, I think I know far less than I said that backwards, but I don't know more than I do know. Okay, so 3 high-level thoughts, though, in that. And so I'm going to spend a lot of time talking about some of the contradictions and sharing with you some work that actually some of it is some of the same things that Emily presented. But maybe you could argue I'm just kind of glasses half empty, and I pose it as more of a, scratch my head, I don't understand how to reconcile. So the other thing I did when I was preparing this is I went back in my microfinance folder and I looked at a deck from 20 years ago. Turned out it was still pretty fine to use as an outline of some things. So here you go, here's except the digital, that's new. That wasn't there 20 years ago. So there's going to be one bold part that's new. Everything else is exactly what was in my deck 20 years ago. I'm not going to read through everything, but microcredit fans, what are the advocates claiming? And that was a list of some of the things claimed. Yes, there was actually a micro-lender here in South Africa that asked me to help them write a proposal for funding to measure the impact of positive impact. They only wanted me to talk about the positive story of microcredit and how it could mitigate and prevent HIV. Then there were the critics. Lots of different stories too, some of which we've already heard from Emily just now. The new one is the bold on digital. As an economist, right, I think we're all kind of would agree that the idea of reducing transaction costs to get a loan down to 3 clicks is pretty exciting. As a behavioral economist, it's pretty scary. So that's an area that is really important for us to do more work on. Contracting questions, a lot of this overlaps with questions both Emily and Lorenzo were just presenting on. Again, I'm not going to read through the list, but there's just tons of different contracting questions about information asymmetries and adverse selection, moral hazard, and selection, choosing people, and et cetera. Likewise, there was a set of behavioral questions that applied both to savings and credit, over-borrowing, under-saving, interest rates. One of the puzzles that I still am baffled by in any context is when someone is borrowing at 80%, if their return on capital is really exceeding that, then there must be some story going on that doesn't scale. But if their returns to capital is not above 80%, then the real puzzle is they have a risk-free return on investment of 80% by just borrowing less. And so that's always struck me as just a puzzle in a sense. And then the next was about 6 slides about why to randomize. I did skip those for everybody here, but so second reflection. One of the challenges, and this is true of a lot of other areas that we've heard from in other sectors, and we'll hear more on, that there's heterogeneity across people, heterogeneity within people across time. But there is one thing that I think is a little bit different about finance, which is that finance is not an end goal in any sense of the word. It's a means to an end. And so inevitably what that means is that whenever you're studying finance, you're studying another market too. You're studying a health market, an education market, an agriculture market. And as we all know, development economics is basically all about studying market failures in all these other markets. So whenever you're studying a market failure in finance and you're trying to understand it, you inevitably have to also be thinking about the market failure in education, in health, in agriculture, in land, whatever that other intermingling market is. And that makes it more complicated. I don't mean to sound lazy, but it does. It makes it a more complicated situation. It makes it much harder to generalize. Which then leads to my third kind of higher level kind of reflection, which I'll refer to as the catch-22 of external validity. This is something Greg Fisher and I wrote about in a thought piece in Papers and Proceedings about 9 years ago. The context was about business development, business training. But the basic point is when we think about external validity, we're usually talking about it in some combination of theory and empirics. We're talking about having some understanding of why something works. And then we're also inevitably thinking about having enough data that we feel like we can validate that theory. And then the idea being we can go somewhere new and have a prediction that we feel like is on solid ground for what will happen. So there's 2 ways that we see research done and that we can try to tackle external validity and try to generate external validity. And to be clear, I do not put these in any sort of rank order. I think the world needs both of these, and there's value in both. One is to go narrow. For example, take one industry, one firm size, one key decision, one moment, and really get a precise understanding of what's happening in that moment. And you have a nice tight theory and good empirics, and that's where a lot of the kind of theory-based experimental designs have been designed around that kind of approach. But then you end up with a really tight theory that might be robust, but then you have to ask yourself in the grand world, how is that going to work for policy writ large? How does this apply in a grander way if you're a government and a bank and doing something? The other is to go broad and do things like, what's the impact of microcredit? Go and make loans, right? Obviously here, you get a limited understanding of the why because of all these other intermingling markets and heterogeneity and all these reasons. And this is similar to the point Chris was making yesterday, too. But you do get a very hand-wavy result that allows you to have perhaps more confidence that the kind of larger policy will generate a certain treatment effect. Okay, so now I'm going to dig into a few points of more narrowly on and I want to start with the very first question that I put up from my deck from 20 years ago. But one of the themes here is, you'll see me come back to, is more emphasis on kind of meta approaches of putting things together, less on the individual studies. So Emily already described the 7 microcredit impact studies that were published in Science and AJ Applied. And Rachel Meager had some work that put these together in a Bayesian framework, reanalyzed them, and found meh results on average, but evidence of a good right tail that is consistent with the gung-ho work that also was done from India. So I think of that, when I think about what the takeaway is from that research, I think of Rachel's paper far more than any one of those individual papers. But how did the industry respond, I think, is informative, and then also how researchers responded to that. The industry responded first by calling their PR team and telling some stories. So that's fine. It's not great. But the second thing they said is, but you didn't measure long enough. I always thought that was a little bit odd because, well, first of all, the measurement was usually 1 to 2.5 years in those studies. But my reaction was, no, we didn't measure short enough. And it goes a little bit back to that narrow, broad point. And we didn't know what people, and the pouring water on the table, we didn't know what people did with the money. Like, usually the first measurement was after a year. And so you don't really know what the process was. So I've always thought we needed more short-run measurement. That applies to other things, too, cash transfer studies, things like this. The second thing they said, oh, but look at our 100% repayment rates. The clients have demand, and they keep coming back, and just like alcohol and tobacco, they, repeat buyers. They didn't make that analogy. I added that. But the 100% repayment rate should be something that, as economists, we kind of scratch our head and go, wait a second, that doesn't make sense. That means you're not doing your job as a bank. Didn't we learn that you should be diversifying and people can take risks? The last point they made is, but this is all on the margin. We want to know about the big expansion of going from no microcredit industry to a thorough industry. That's actually a fair point, I always thought. And from a policy perspective, the lever we have is on the margin. So those studies were measuring the actual changes that we were seeing from a policy from an individual firm. But they were perhaps underselling the big picture. And this is where one of my favorite papers that really changed the way I thought about it, definitely changed the way I talked about it. When people say, what was the impact of microcredit, I was usually fairly meh, and I changed my talking points considerably based on the paper Emily discussed just a moment ago. So how have we responded? And some of this was happening a bit simultaneously with savings. We've seen a tremendous amount of work now on promoting savings and figuring out how to introduce behavioral economics into savings product designs. Ultimately, let's remember that when you're ultra poor, even if you can help someone save, you're going to save a very, very little amount. And what's that going to add up to? Maybe you can take the very off, but it's still going to be very little, or little. I didn't say very. There's been a lot of work improving selection, some of which we've heard about, and I'll share a couple in a moment. And a lot improving product design. The best way I think of it is just about matching cash flows, which is the role of a financial intermediary, is to understand the cash flow needs of somebody, and needs means when they have it and when they need it, and then having an investor on the other side and matching. And that's not the approach that microcredit has historically taken, but as we've heard from both Lorenzo and Emily, a series of papers that are making important headway in that vein. Having said all that, we put way too much on any one paper. And so now I'm going to, that's kind of an implicit subpoint of this catch-22 of external validity. So here are some of my personal favorites. That's by personal, I mean of like mine, and their contradictions. The first, Nava, if you're in the audience, I'm not sure, I think I told you about this, but maybe not. So Nava and I have a paper in which we find that those who are time inconsistent are more likely to open commitment savings accounts in the Philippines. A few years later, John Zinman and I did a test of savings interest rates. It wasn't really about commitment savings. It happened to be commitment savings accounts, but we kind of throw those questions into the survey too to just see if it would replicate. It did not. But we don't know why. We just have literally it's a third of a page. It's a really long footnote in our JDE that just lists a whole bunch of reasons of why it maybe didn't replicate. So take the 7 microcredit impact studies that we already talked about. There was an earlier one that John Zinman and I did in South Africa. It was a consumer microlender, but they lend at 200% annualized interest rates, and they were actually the only one to generate a positive average impact on income. Does that mean policy is just jack up the interest rates to 200%? Obviously not. I think there's an important lesson there about credit being a risk tool, just like Chris's dissertation from way back when. And but that's a bit of a conjecture, to be honest. It's just one result, but it is a seeming contradiction there. Is selection positively predictive of impact? So we have the project from Egypt that Emily talked about, and she told you the glass is half full part about it. She talked about how there's people that were identified that could do much better. I'm going to talk about the people that did much worse. Who were they? They were the people we called over-optimistic, based on the psychosocial questions, and they did worse. Now, you might think that seems to me like a contradiction with gung-ho. It's kind of close, right? And I'm not saying either of those results is wrong, but I'm just pointing that we just don't have a deep understanding of what that self-awareness is about whether you should or should not be taking out a loan, and will you do better. And what are the differences there? There's tons, right? There's tons of difference across these settings. The loan terms were different. Different size loans. One was going 4x, big loans to try to get to SME. The others were small. One country has 2 syllables. The other has 3 syllables. Maybe that was it. So just tons of differences. Who knows? Like we need a plethora to kind of get past that. In Mali, we find the results that are really striking there, where we have a 2-stage design. And we find that the people who took out loans had high returns to capital, and the people who did not take out loans had 0 returns to capital, because the second stage we do a cash drop, so we measure returns to capital. So that means there was like really good selection there. It was like you got exactly the right people. Contradictions 4, 5, 6, 7, and 8 are put all together. I read the list of the flexible lending as being a bit more mixed in terms of what we're learning. It's the idea I could not be more excited about figuring out how to design products that actually match the needs of people. But I do think of the results as being a bit mixed for being prescriptive at this point. It's not all strikingly consistent, so I'll share the last 2 with you. This is work that is fresh, that Chris and I and others we've worked on. We have 114 unconditional cash transfer randomized trial papers that we found in a systematic review meta-analysis. We put them together in a Bayesian context, not the underlying data. We're way too lazy. We are working on that, but later. This is just using the point estimates reported in the papers. And strikingly consistent results across a whole myriad of outcomes. Labor supply always up, just like Abhijit referred to yesterday. Here's 2 points that I think are particularly important that we got out of it. First is that those are the posteriors across the 114, and the final column is the grant size. I realize it's not readable, but it's sorted ascending. So what's the punchline here? Linear. The returns to capital, the returns to getting cash were linear. The outcome here is consumption. So there's no convexity or concavity in the grant size. The second result was time. So that the second column on the right is number of months since the cash was dropped. And what we see here again is it actually does go a little bit left if you do this parametrically. It does dissipate some, but basically you do not see that much dissipation. But a part of that is because you're combining 2 different effects. If you're continuously giving people money, what we call stream ongoing, what you actually see is an augmentation, amplification. Because what's happening is they're consuming some and they're saving some, the savings gets invested. So you actually see treatment effects that go up over time. If it's a stream ended, as in they gave $100 a month for a year and then they stopped, or a lump sum, then we do see a dissipation. Not to 0, still long-term impacts persist, but it does drop some. That last part is, I think, a very important point for finance, and it actually surprised us. Because if the stream in the long run is the same as the lump sum, and they really look quite similar once you go out a year or two from either of those, that actually says that the financial markets were working better than we expected. Because it means they were able to unravel the timing and unravel the psychological labeling that maybe that happened to. Whatever it is, in the long run, they look very, very similar in terms of impacts. So from a policy perspective, it kind of means probably do lump sum because it's easier and logistically. But it was a kind of a rosy interpretation that we think is appropriate for that. So where does that leave us? So 3 paintings that I think are tell us a bit about where we are. Something with a bull, something with an animal. I can't really tell much about what's going on the left. That's kind of where we are. We have some understanding of the world, but it's still pretty vague. I think the best we can realistically ever get is to a Picasso. It's going to look a little weird. Not everything's going to be right, but you know, we can tell what it is. And I don't think we're ever going to be in a painting that basically is like a photograph. That's just not a realistic endpoint. And let's try to go for the middle. Thank you
very much. Thank you very much, Dean. I have heard more about art in the last 18 hours than I expected to in this week. Well, some of the many surprises. Let's have some questions for the team before we break for tea. Let me see. Yes, over here, I see 3 questions on this side. We'll take these 3 questions. Please go ahead.
I have a question about what we learned from multiple studies when there is so much underlying heterogeneity, and how we can design future studies using digital, basically, to be more precise. To be more precise about figuring out where the effects are. And I'm thinking, for example, about our commitment savings and what does it mean to not replicate. I think when you've got, especially in behavioral biases, we know so much more about the underlying heterogeneity of individuals. And I wonder to what extent using digital could help us to more precisely figure out which populations are going to benefit and not from certain interventions.
Okay, let's take Rachel. I see your hand as well. And then we'll collect 3 questions and we'll give the panel an opportunity.
Yeah. Rachel Yafta from the Economics Department here at Stellenbosch, and my question is complementary to the first one. I was wondering how one would think about credit emerging adjacent to, in a digital marketplace, adjacent to a vertical such as food delivery or autos, for example. Take food delivery. So when they provide a service to the restaurants on their platform, they have access to all the data, so they can virtually see cash flows and see red flags or good news before the restaurant owners do. And that gives them that solves some of the friction and gives them the opportunity to offer credit. So how would one think about this systematically in a study? Thank you.
Thank you, Rachel. Final question. In the front here, please, sir.
Thank you very much for such a wonderful talk. I have 2 questions, please. And I'm speaking from the perspective of a junior researcher here. And I had this yesterday when Esther was talking, and I would like some clarification here. So when you say that you're going back to default, pardon me, what did I write here? So we're talking about initial conditions. So you're talking about whether credit mattered, and then you thought about entrepreneurs who perhaps had either existing businesses of some sort vis-a-vis those that did not have. Well, at the point where you discovered that somebody surely can benefit from credit vis-a-vis those that could not, I'm wondering whether an RCT does not help us to deal with the initial conditions, and thus asking the question whether an RSC does not necessarily help us to get rid of the adverse selection issue. Probably I did not understand it well, but I'm just wondering why we are seeing that difference now, and that we were not able to see that much earlier. If I misunderstood it, just take it from a junior researcher. Then secondly, there's this interesting study by, I think, Jack and Suri that you mentioned regarding consumption smoothing. And for those that already, that were using, say, the M-Pesa accounts, they were able to do a better consumption smoothing than those that did not. Now, drawing on that, I kind of tried out a research, and this is somewhere in Ethiopia, and I was trying to get to the bottom of it, asked Robin, and we didn't get to the bottom. Maybe you can help me here. What I try to do is something similar, looking at the extent to which financial inclusion, ownership of those bank accounts, and specifically in that case, they're using savings, to what extent that can interact with, credit, climate effect to impact welfare. And in our case, we are not seeing a positive response. Individually, yes, you can see that yes, finance can lead to better welfare, but in terms of what the interaction, it is not seen. So the question there would be, do we then have to worry about the duration of use of these products? That perhaps in one case, we're talking about a product that's maybe recently rolled out, and that maybe the magnitudes are so low to have impact, or what is happening in here that I can look at? Because this is an ongoing work. Thank you very much.
I'm going to start with Emily. Would you like to try any of the questions? And then I'll give Dean and Lorenzo an opportunity.
Sure, I'll take the second two, and I'll leave Nava's question to Dean. So on the digitization and what you can see, I think that this is exactly where there's some, a lot of interesting opportunity. So with the food vendor in the picture with the QR code, now that people are buying food with their accounts, there's a digital trail of all of those revenues. You can take that potentially to the bank, or maybe you could design a revenue-based product instead of just a loan. So I think all of that is really exciting. I don't think we've seen, to my knowledge, studies of these, and you can imagine lots of markets where this is possible. I guess the paper Lorenzo talked about with bicycles is close to that. I think one interesting question, though, is how much do people divert? So in the Indian context, you could maybe put a QR code for your brother's account and not yours if you want to default. So I think there are lots of very, very interesting research questions on that. And then on the microfinance results, so I think you're right. Anytime we're looking at heterogeneity, we're not randomizing that feature. We're not randomizing people into the prior business. And so what we find is that prior businesses seem to grow. Part of that's mechanical, because they're just more likely to have businesses. Part of it we think is selection. But what else could be different? The prior business owners are richer. So we can look, does that sort of matter? We show that in our context it doesn't. But I think this is a problem with the methodology and heterogeneous treatment effects in general. Also, I think it's a very coarse measure of who can benefit, right? It's something that you can observe in the data, but certainly there would be potentially better ways of looking at that. And I'll pass to Dean.
Sure. Dean, please go ahead.
So two thoughts. Let me. So for Nava, for your question. So I think for what it's worth, because we have that angst. I have very much that angst, and that's one of the reasons why we jumped on cash, because it's not quite a pill, but it's closer to that end of the spectrum where we felt more comfortable. As we have another project we're working on, the entrepreneurial training and promotion, and it's definitely harder. You're aggregating up things, and then you're scratching your head, and you're trying to find parameters to try to parameterize the differences, because that's the whole point at the end of the day, is to do that, but you need quantity to do that. And even on cash, there's some questions that we want to parameterize, and we end up with 3 studies in the set. So what happens when you target men? Well, not too many programs target men and compare, but it's in there. But if you target women, you do get much bigger effects than the targeting untargeted. So, but that's I think you're hitting on exactly the one of the key struggles, and it's not even just the intervention, but it's also the measurement. Right? Mental health, for instance, is on here. We see nice big effects on psychological well-being. How do we do it? We take the ways that each study did it, we standardize it, and we let that be it. But what if some studies just had more variety, more homogeneity than others? That's not right. You want to be able to put it into real terms. So the ones that are in dollars, we can do that. The other ones, we'd have to take a leap of faith and do, or get the granular data, and then you can do more. So it's not to say these are, like, you can't tackle these, but these are challenges. But this is why I would say, you don't do any one approach. We triangulate here. The other issue does relate back to the digital, too, that you're raising, which is, I think there's tremendous opportunity to do large-scale digital replications. It's so much faster, so much cheaper. But at the same time, you're gonna have your hands tied on the data you get, because you might get massive samples and quicker, et cetera. But you can't ask time inconsistent preference questions in the same way, or anything else, household bargaining power questions, the million other things that you get out of a survey to have that richness. Let me just, I want to add one thing to your question in the front as well, which is, I think we struggle with this in a lot of contexts, from the policy versus the understanding the theory. So let's just suppose there's heterogeneity on gender, and you run a study, and then you interact with gender, and then you say, okay, great, the program worked better for women than men. And so that might be fine from a policy perspective, and you learn something, and you can know that. But we don't know whether that's really about gender. What is it about gender that's doing that? Is it about the place in society, the place in the household, the access to education? And it could very well be that it's not about gender per se. It's about any of those other things I just said. And so anytime there's a heterogeneous treatment effect that we're talking about, you do want to try to understand the why underlying that, recognizing, as Emily said, that no one randomly assigns gender to people. And so that's true of any sort of heterogeneity analysis, is that it helps to try to understand the why of that.
Lorenzo, would you like to add?
Yeah, maybe I'll add briefly on the second question. Of course, there is a lot of excitement about this type of data sources for new type of financial products. So let me add some caveats. Let's take the excitement as given and add some caveats. So one is that, I work with banks, with financial institutions. There is a lot of micro decisions to be made in offering these loans. I'm a bit concerned about, random places starting offering loans without much background. So that's one area in which this external value chain finance is probably more meaningful than having, small restaurants offering credit. The other point is that, sure, these things help with information, but some of the other constraints, like enforcement, are still going to be quite relevant in this setting. Right? Maybe I get a loan from a restaurant, and then I change neighborhood and start serving some other restaurants. And so this boils, I think, down to a point that I made in the presentation, which has been emphasized by others, of course, as well, which is, for this to work, it must be that the value of the relationship with this specific partner is large enough such that even if I could go somewhere else, I want to stay in this relationship, maybe because of other benefits of having a contract with this restaurant, besides the pure credit provision angle. So these are two things I wanted to emphasize.
Thank you very much. Ladies and gentlemen, it's time for tea, but before we do that, I see on the program, Roelof, that there is a photo to be taken. Do I need to help with logistics from here?
Yeah, can we just ask everyone before you grab coffee, Steers wants to take a group photograph on that side with the coffee served?
On the veranda?
On the veranda.
Very good.
So everyone, and then as soon as that's done, can I ask the participants in Friday's writing workshop to stay behind? Steers wants to take their own group photograph.
But before we capture you forever on a picture, join me to thank Emily, Lorenzo, and Dean. Thank you very much.